Hello traders, welcome to this ultimate guide on order blocks. Order blocks are really powerful concepts used by banks and institutional traders. If you have ever wondered why price accelerates or reverses at certain levels, today's deep dive will give you all the answers. After this 20 minutes masterclass, you will get to know how to identify an order block, how to confirm it using certain confluences, and how to trade them like a pro. So stay tuned, watch till the end. Let's start together. So before we jump into trading, let us define what is an order block and what is its key characteristics. So by definition, order block is a zone where institutions have placed their buy orders or sell orders. So let us consider this zone is their buy order zone. So what normally happens, what we see, what we observe on charts is price is hovering around, then price goes to a particular level, and then all of a sudden a big impulsive move comes, price comes back, mitigates it, and then it goes away. So what is happening here is this is that particular zone where institutions want price to come and from where they want to buy. But when they buy, their orders are so big they cannot execute all of their orders at once. So with their first lot, the price goes up because of the volume of their orders. But if they will purchase their second lot on the peak, they will not have a dollar cost average. That is why they bring price one more time back to that particular zone so that they dollar cost average that price. And then once it mitigates this order block, then they goes in one direction up to the moon. So the key characteristics are a zone which acts as a springboard, and we should not relate it with support and resistance because that is a different characteristic and this order block is a different characteristic. Unlike support and resistance, order blocks are where liquidity is stored and big players revisit this liquidity. So let me explain. This is a particular consolidation. Consolidation means build up of orders, engaging buyers, engaging sellers, build up of orders. Once this consolidation is finished, they take one side of the liquidity completely up to that particular zone on which they have decided that we will buy. Then they take that price to the other side. The price goes ultimately to the other side because of the volume of their orders. Then they wait for the price to return. Once the price returns, then they execute remaining orders and price shoots in one direction. So with that, our takeaway is that there are three particular characteristics associated with order block. And why do order block works? Because institutions, banks, their orders are huge, they need liquidity. This is the way they mitigate their this is the way they achieve their liquidity and they dollar cost average their prices. And once it is mitigated, it goes in a single direction, in one direction. Now, since we have understood what an order block is and how it is formed, let us discuss how many types of order blocks are. For different traders, I have seen a lot of traders trading a lot of kind of order blocks like propulsion order block, breaker block, rejection block. I don't know how many kinds of order blocks they trade, but for me and for you, there are only two order blocks. One is bullish order block and one is bearish order blocks. So on chart, they look like this. Forms before a strong upward impulse move. On retest, it acts as support. Sometimes price consolidates, then breaks out with high volume, and then again on retest, it acts as support. Similarly, for bearish order block, it forms with a sharp drop, price retest, acts as resistance, and then price breaks down. And sometimes a strong consolidation, then price goes in one direction in a downtrend, comes back, retest, and price starts to fall down. So there are these two main types of order blocks, bullish and bearish. That's it. It is only matter of selection of price segment. If you are selecting this much segment of price, then you have to analyze a lot of things in that: rejection block, propulsion block, breaker block, order block. But if we limit ourselves to a certain price segment and select only a some segment in which we can identify easily that this impulse move has originated from this particular candle, that will be our order block. Now let us talk about how to spot a high probability order block. So I have a very simple 3-step solution to this. Find an impulse move, mark the last candle, check if that particular zone has taken out some liquidity before. So these are my 3 steps. Let me explain how I do it. So this is my impulse move. This is the last candle along with this particular candle. So this whole is my last candle. Now this candle has taken this liquidity. This whole consolidation means build up of liquidity. This area has been taken out. Now this candle came down to this liquidity. So my 3 steps are completed here. Let me repeat them again. Impulse move up after taking out of a liquidity zone and then marking of last down candle. See, price came back. Now we have to analyze this price using price action. Pin, hammer, engulfing, all are indicating that price has to go up. Price starts to go up and then they will take it to their desired particular location. Now again, price went up, again price went up, came back again, mitigated this particular order block. How it happened? At this particular level, price has taken a lot of liquidity, went up, made consolidation again. It means they were still executing their orders. Once this impulse move came, the second impulse move came, now they do not want to add more orders in their basket because their dollar cost average will not be efficient enough. They went up, waited for price to retrace, one more time tap this particular order block, and then they went. So we have to understand this, that in a particular price segment there can be multiple order blocks. Do we have to trade them all? No, we do not have to. We have to identify most high probable order blocks. With these 3 steps, you can identify the high probability order blocks. Now that we know how to trade them, how to spot them, let us discuss about the strategies I use to trade an order block. I have basically only 2 strategies, nothing more, nothing less, only 2 strategies to trade an order block. First strategy is liquidity grab and reversal. It means during the formation of order block has taken some liquidity grab, then it gave an impulse move on the other direction. So institutions often fade out traders before reversing. This is what is happening here. If price sweeps past the order block but quickly reverses, it is a trap. How? They are inducing breakout traders. Breakout traders will be very happy after seeing this breakout and close just below this wick. Institution is in order to place their orders, they need to catch a lot of orders. So institutions are catching these orders. It means liquidity going against with an impulsive move, coming back, mitigating their own orders, adding more orders. Mitigating orders means adding more orders, adding more orders, and then going in one direction up to the next liquidity. So our buy trade will be something like this. This will be our stop loss and take profit up to next liquidity level. And I clubbed this thing with some other things also, which we will discuss at later stage. But this particular example is a perfect fit up to this liquidity level. And why sometimes this doesn't happen and sometimes up to this level is enough. Even then, that is a 1:4 trade. Up to this level is enough. We have to identify it using some other tactics also, which we will discuss in some other video. Right now we are discussing how to trade order block strategy. So this is one strategy. Entering on this particular order block, stop loss is here and your take profit up to the next liquidity level. So this is one buy trade. The second strategy is breakout and retest. How that works? Price is in consolidation here. Then this consolidation breaks out. So we have to identify consolidation means also liquidity development. And liquidity grab is also liquidity grabbing for institutions. So institutions need liquidity, either they grab it or they develop it. So they keep the price in consolidation, then they break it out. So that's a breakout. That will be a breakout. And then they come back, mitigate their orders. It means add more orders and then go again up in the same direction. So this particular strategy will be up to this liquidity. So from here the trade will start and it will end up to this. Is also 1:5 trade, very good trade. So most of my trades are 1:5 and I close my trades if I don't feel comfortable a little bit early. Otherwise I write them at least 1:5. So these are my two trading strategies for order blocks. Everything revolves around liquidity. Now, before you start trading order blocks, be aware of these common mistakes. Mistake number 1, trading every consolidation. When a trader learns order block trading strategy, it fascinates him well and he starts to trade every order block. So every down candle or every up candle before any move down or up might not be an order block. You have to identify order block properly. You have learned it. Now you have to play with the charts. Go into the chart, spend some time, do a lot of practice, and then you will be able to identify it easily. You do not have to trade every candle considering it as an order block. The second common mistake is ignoring market structure. Market structure tells the story of whole market. Market structure is the context. Without knowing proper market structure, order blocks will not work for you. And if you want me to make a detailed video about market structure, do comment below and let me know. The third mistake is very tight stop losses. Now, when I do live streaming on my channel, normally I have very tight stop losses. Most of the time, I win my trades. So a new trader sees this and then they want to trade like this: 1 is to 10 trades, risk to reward ratio 1 is to 10, 1 is to 7, 1 is to 8, 1 is to 5, and they will not get it at the start. Do not get disappointed with this, do not get disheartened, but you need time, you need practice. So when you are starting, do not keep a very tight stop loss. Do a proper trade management. Start with smaller lots, bigger stop losses, so that market gives you at least one chance to get out of trade profitably, or even at break even. So do not use tight stop losses in the beginning. The fourth mistake is overcomplicating it. You do not have a lot of boxes, you do not have to use indicators, you do not have to overcomplicate the things. This is a bullish order block, this is a bearish order block. I have seen charts with marking of a lot of order blocks. You do not need this. Keep it simple, keep it clear. Try to trade only in one direction. If you are wrong, you will be wrong for one day. But if you are right, you will catch massive moves. So keep it simple, keep it in one direction, and you will be getting there. Order blocks are one of the most reliable concepts in trading, but it requires patience and practice. Start with your chart. Start marking order blocks on your charts and see and observe how price reacts to them. With that, if you like this video, hit that like button, subscribe, and comment below what was your best takeaway from this video. Till then, stay disciplined, stay safe. Thank you.